All right, it's 1 o'clock now. Let's give everybody another minute or so because I see people still popping in. So for those that are with us, give us another minute and we'll get started. Okay, I see a lot of people popping in now. Let's go ahead and get started. We got a lot to cover. Hello, everyone, and thank you for joining us for today's webinar, Putting Your Best Foot Forward in a Capital Raise. My name is Tom Gabbert, and I'm the host of today's webinar. I'll also be pulling a little bit of double duty. I'll be jumping in on occasion for some panelist discussion as well. So we have a lot to cover, so let's get started. I'm going to introduce today's panel, and I'm going to start by introducing Christopher Day. Those of you who know him, he goes by the name of Toph. So Toph serves as the Chief Executive Officer of Elevate Ventures, where he took the reins in August of 2022. So coming up on a one-year anniversary. Christopher has been a community builder, job maker, and wealth creator throughout his entrepreneurial endeavors over the past 25 years. Having co-founded 8 businesses in 7 different sectors, he's been a part of $600 million in transactions and has delivered nearly a 4x cash-on-cash return when exiting for investors. These experiences and interactions across many industries with strategic venture capital and private equity investors give Christopher a truly unique perspective when evaluating people and opportunities. Welcome, Toph.
Thank you, Tom. Excited to be here.
And David Kerr. So David is the managing director of Alos Ventures. David is a career entrepreneur with expertise in building and growing tech companies. He has over 2 decades of experience in executive management, business development, international operations, fundraising, and sales and marketing. Prior to joining Alos, David was most recently the CEO of Octiv, a B2B SaaS company focused on document generation and contract lifecycle management that was acquired in April of 2018. And prior to Octiv, David served as the VP and general manager of Groupon and the general manager of e-commerce at Angie's List. David also held an international post as president of GHX Europe. He also led GHX Mobile Solutions after No Inc., where he was the president and CEO, was acquired by GHX. So welcome, David.
Thanks, Tom. Looking forward to the discussion.
Okay, and I am Tom Gabbert. As I mentioned, I'm the CEO and one of the co-founders at Milestone Business Solutions. Milestone provides fractional accounting, CFO, HR, and payroll services to entrepreneurial companies. So similar to these 2 gentlemen, I am an entrepreneur at heart. This is my second fractional services company. I founded and ran a fractional company called M Accounting that did accounting and CFO services for entrepreneurial companies. Did that for 16 years before selling to a bigger player on the West Coast. I ran operations for that company for a couple of years and then got the itch to build something again. So we launched Milestone in June of 2020. In the middle of a pandemic. What could go wrong, right? In a strange way, though, it put wind at our back and was the perfect time to launch a fractional service business focused on finance and HR. So during my almost 20 years of providing fractional CFO services to entrepreneurs, I spent a lot of time helping them prepare for a capital raise or prepare for an exit. So it's a nice segue into our panel discussion. So with that, let's jump in. What we want to talk about today is really how you can best prepare for a capital raise and put your best foot forward. So it's no secret right now, guys, that the funding climate has changed significantly over the past year. It is harder and takes longer than we've seen in a while. So I thought we would start this discussion just by talking about the overall climate, and I'd like to get your perspective. So Toph, let's start with you. Are deals still getting done? I know it's taking longer, but what does that mean? And what does due diligence look like? So give us your take on that.
Yeah, absolutely. So thank you, Tom. So yes, deals are absolutely getting done. However, there's a much higher level, I would say, of scrutiny on several things. And the vantage point I'm talking about mostly from today is kind of ideation, seed, and Series A. But see, there's a lot of scrutiny on right sizing. So what is your burn rate, right? A burn rate that might have been acceptable, a year and 3 and 5 years ago, let's say, depending on what size you are, let's say a burn rate was $300,000 a month, that may absolutely not be acceptable today. You might have to be thinking of a burn rate that's $100,000 or less, depending on what your growth rate is. I would say that there's definitely flexibility in growth rate. Like it used to be, expectation was 100% year over year growth. I think that like break even is the new sexy, or even up 10 or 20%. So, but if you have a growth rate of even 20, 30, 40% right now, and going back, year over year at this point, that would be considered very positive. Evidence, more scrutiny or evidence of product market fit, going from founder-led sales to process-led sales is difficult, no matter what macroeconomic condition is happening, but it's even more critical now. Reasonable valuation, and then company structure and cleanup. I think we'll talk about that in a little bit more in detail. And then the need for having some other people around the table, right? So typically just one angel or one VC, they're not going to want to be the only ones writing a check. They're going to want several people involved writing a check.
Yep, no, totally agree. And David, what are you seeing from a valuation perspective? So are valuations lower across the board, and does it vary by funding stage? So a seed versus a Series A, Series B. What are your thoughts there?
Yeah. Well, first, I would echo what Toph was just saying in terms of profitability, or at least a path to profitability is kind of the new sexy versus the 100% year-on-year growth, or going from a 3x to a 2x to a 1x in terms of growth and so forth. Right now, valuations are definitely down. For later stage, you're seeing, these big firms that were all the high flyers a few years ago, Tiger Global, they are really struggling. So B rounds, C rounds, D rounds are all 50 to 90% lower than they had been. I would say where Elevate plays, where Allos plays, and that seed and Series A, we're seeing things now more in the 4x to maybe 7x, whereas in the past, it was not unusual to see anywhere from a 10x to a 15x. And that's on your top line for folks that are not familiar with that. So we're seeing much more reasonable valuations, and you're even seeing, what used to be kind of the 10 million was kind of a starting point almost, where people are like, it's a give me, even if that was 20x or 25x. Now we're seeing deals as low as kind of a 2 million pre, 6 million pre are not unusual anymore. And we're telling founders, we're seeing founders that in a way are kind of stuck in 2021, are like, come on, I've got 300,000 in ARR. I should have a 15 million pre-money or a 10 million pre-money. And like, hey, those days are past. You should be grateful you're getting a 6 million pre, move forward with it.
Yeah,
so definitely a different environment.
And talk about diligence real quick. Is it taking a lot longer? Are companies coming under more scrutiny now than they did a year ago?
So if you want to start on that.
Yes. So I would say, from personally what I see, I don't see much change in diligence necessarily. Like we always would go deep in diligence, right? I think it's more around, is the company, if they're over their skis in terms of valuation and where they are from a revenue standpoint, a revenue run rate standpoint, most of the discussion is around, are they willing to right size? And if they're willing to right size and make sure they have a reasonable plan, a disciplined plan to go narrow and deep, and lay down the proof points they need of growth, that's where most of the conversations that we have come into play, and also around structure. And we'll talk about that a little bit later, I think, but that's where most of our conversations lie.
Yeah, makes sense.
And Tom, I do think what you're seeing different, and we're going to get into this in a minute, is around structure. From our perspective, due diligence really has remained the same. It's still, you're looking at the founder, the background, product market fit. You're looking at models that we're going to talk about a little bit more later, and you're looking at the overall market and the tech platform itself. But I don't think due diligence has really gotten longer or more difficult. I think it's, hopefully most companies are doing thorough due diligence.
Yeah. Okay, good. All right. So Toph, tell us a little bit more about Elevate Ventures, for those that don't know, and where Elevate fits in the funding equation, including like the types of deals you're looking for and how best to leverage your team.
Yeah, absolutely. So Elevate, so we have $215 million in assets under management. We write checks anywhere between $20,000 and $2 million in any given round, up to $4 million in any given company. We invest cross-sector, so we are in software, hard tech, healthcare, sports tech, ed tech, ag, food, sports tech, you name it, we're in it. And we invest at the ideation, pre-seed, seed, and Series A stages. So those $20,000 to $80,000 checks are prevalent in the pitch competitions that we do that we consider to be in that ideation and pre-seed range. And then as companies move upstream and they are in a Series Seed or a Series A stage, that's when our checks can be in the $1 million and sometimes even more range in a given round. Over 50% of our portfolio is in software, but we do think that's going to change year over year here quickly. I mean, we're seeing things in ag, food, ed tech, sports tech that is really, really exciting. So that's a little bit about where Elevate is and what our sweet spot is. Also, one quick note is we invest in 17% of the companies that pitch. So, our mandate is also to plant green shoots along with the investments that we make. And so we invest in about 17% of the companies that come through and make it to the point of pitching, as opposed to typical VC, that number is probably 2% range. So that's a little bit about where Elevate stands.
Yeah, perfect. And I know you guys have played a really important role. We've had a number of clients in common over the years and just have been terrific partners. So anyway, we appreciate all that you guys do. David, Allos is more of a traditional venture capital firm. So tell us more about your group and the types of investments you make and what makes a good investment in your opinion.
Sure. So the firm is about 13 years old now. We've got about 160 million of assets under management. Like Toph, we do early stage. So we do seed, Series A, seed plus. We've done a couple of pre-seed. So unlike Toph or Elevate, we don't necessarily do a lot of pre-seed. So it's really nice to have them in Indiana, laying the groundwork for that. We're looking at B2B SaaS exclusively. So we are not doing any hard tech. We are not doing any life sciences. We feel like, given the expertise around the table that we have from a partnership and from a team, that's where our expertise sits. We also are geography based. So we look at the broader Midwest. Sitting here in Indianapolis, we kind of look at almost a 5 or 6 hour kind of range. We've done a few things outside of that, but for the most part, it's kind of Madison to Nashville, Pittsburgh over to St. Louis is where we would look, with a pretty high concentration in Indiana and Ohio, where we have offices. Check sizes start at about 250,000 and we'll go up to about 2.5 million. We will lead, most oftentimes we'll lead on a Series A deal where we'll write the term sheet and put the terms together. And what we're looking for really starts with the founder. This business is all about people, especially at our stage. So we're looking at people who've either lived the problem before, maybe they're a second or third time founder. So maybe they've already had a couple of successful exits, or candidly, maybe they've had some that are not so successful. We like to see the scar tissue. We're then looking at product market fit, traction, whatever that might be. Ideally, it's kind of past some friends buying your solution, but you've moved into a couple of new areas there. And then what's the founder looking to buy? So many people get excited about venture. I'm sorry, what's the founder looking to build? They think every business is a venture backable business, and it's not. That doesn't make it bad. Oftentimes I'll tell people, hey, you should keep this, run this, do family and friends, do an SBA loan. But we're looking for businesses that can get to 20, 30, 40 million in top line revenue in about 5 years.
Yeah. Okay, perfect. Well, that's probably a good segue. Let's shift gears a little bit and talk about some things that we can do to prepare and increase the odds of success. So, David, I'm going to pitch this one to you. Talk about what an entrepreneur who is starting the process, what they should be thinking about. What advice do you have for them?
Couple of quick things. So I'm going to just build off of that. This is about people first, and it is about that, ideally somebody who's lived the problem, or maybe a second time entrepreneur, ideally. So from our perspective, we'd like them to have just a really good knowledge of the business that they're going into. If you look across our portfolio, most of the people were in a business previously where maybe they were a a product leader, or maybe they were a sales leader, and they saw an area where there was opportunity to improve upon a current system and have some digital transformation. So we're really looking for that first. And we also want people that, you got to be on that fine line of crazy. You got to be willing to go build a bit. Tom, you mentioned you're on your second or third one. Toph's built 6, 7, 8 businesses. You got to have a little bit of crazy in you, and I mean that in a good way. I realize we live in a politically correct world these days, and that's not always ideal, but you want somebody that really thinks they can change the world. So we're looking for that first. The other thing I always want people to, you want founder-led sales. You want that founder passionate and able to go in and identify what the user's looking for, spend time with that user, and get that minimally viable product in their hands, and really be able to listen and iterate on that. So those are a couple of the foundational elements, and I'll sure Toph has got a few things to add to that as well, as he's looking for.
Absolutely. So same question to you, Toph. And by the way, I totally agree with the crazy. I love working with entrepreneurs. You got to embrace the crazy a little bit.
Yeah.
So Toph, how would you answer that same question?
So I concur with everything that David just said. A couple of things that I might just from an additive standpoint is don't overthink it. Be confident in your point of view. Be definitive. Go narrow and deep. Don't think that you have to sound sophisticated and have a bunch of different go-to-market strategies and channels, and we're going to go sell enterprise and PLG and channel partners all in the next 3 months. That will never happen, and you actually lose credibility. So just be true to yourself, your own personality, your own expertise. Be true to the facts. The facts, I always say, are good enough. You don't have to embellish anything in specificity, right? I think those things are your friend.
Yep. Love it. Love it. Okay.
Hey, Tom, so I am monitoring our time here, and I feel like we're ahead of time. So I want to give one example of
totally.
this. So we've invested in a company called NCamp in Indianapolis, and this is an entrepreneur, first-time entrepreneur, but he was Luke Jacobs. He worked in an environmental compliance firm right out of college, right out of IU. And he was doing tier 2 reports, which are these certain reports that every company has got to file to the EPA or the state level or the local level. And he went to his boss and he said, hey, you know what? I could do a script that could make this go a lot faster. And his boss was like, hey, we get paid by the hour. Like, don't do anything to innovate there. So Luke saw an opportunity to really transition that. And this goes a little bit to what Toph was just saying in terms of going narrow and going really specific and not overcomplicating it. So Luke quit, and at 24, 25 years old said, hey, I'm going to just basically write a script that will automate this form filling process. And now Luke, I don't know, he's raised like $40 million from some top VCs across the country. Has a really strong, viable business with some of the biggest logos out there. But he went very narrow. He didn't try to create a huge EHS company. It was like, we're going to do this one niche. We're going to do it well. He'd lived the problem. He'd seen the problem, could speak the vernacular of the customer, and has begun to build a nice business.
Yeah, that's a great example. I'm glad you interjected that. That's a great example. Frankly, a great local success story too. So yeah, love that. Okay, good. So let's talk about, we alluded to this earlier, but let's talk about the structure of the deal and how that impacts your odds of success. So I don't know who wants to go first, but let's talk about safe notes versus convertible notes versus priced equity rounds. This is a hot topic, and we were chatting a little bit about this in our prep for this webinar. And Toph, you had some thoughts on this. Why don't you kick us off?
Yeah, so I'm gonna start off with a controversial topic, possibly, and that's safes. Are safes safe? And I've had lots of conversations with other investors, with all different types of investors, with law firms, et cetera, over the last 6 months. And so, number one statement I would like to say is that safes are not founder friendly. Safes are not founder friendly. Number two, safes were originated by YCOM, as we all know, and objectively, I can understand why they did introduce them. It makes sense for them. They're placing lots of bets, kind of standardization. They're basically placing lottery tickets out there. And those companies it's an event. It was an event-based investment. And those investments were largely made in either that company's going to be successful or not going to be successful and dead in 6, 12, maybe 18 months max. So that word event is critical. Number 3, safes were believed to be more to cost less money. And I'd actually argue that safes can cost founders millions of dollars if they're not careful. So what are we seeing in the marketplace? So safes are now used as a funding phase. So people are stacking safes on top of each other with different terms. And when those all go to get converted someday, it can create much, much more expense, creating many different series of shadow stock. How those are converted, arguments can ensue. I've even seen investors demand that founders give up some of their equity because they want it calculated differently. And to avoid a whole litany of legal tracking issues in the future to save costs, I've literally seen founders agree to fork over part of their equity to certain investors, which is awful. That is not founder friendly. There's also they're actually a security, but they're really not treated like a security. And there's actually legal precedents that there are certain situations, depending on the type of company that you are when you enact a safe, that it can trigger automatic conversion to other types of corporate structures that you didn't anticipate and weren't even aware of, that can result in fines and penalties. You also technically should be issuing K1s. 2, if you're an LLC, you should be issuing K1s, and nobody is, to those investors that do safes. The list goes on. We're actually thinking about writing a very in-depth paper on this, because people like to say, oh, that's how they do on the West Coast. I love it when people say that, because it doesn't mean anything. And so this is a public service announcement. Don't think that safes are safe. Don't think they're founder friendly, because they are not necessarily founder friendly. And they often don't incorporate all the things that you should have when you're raising it. I think that price rounds, oftentimes you should try to price your rounds. Sometimes when you don't do that, then the fallback in the tried and true convertible note is a much safer route to go.
Yeah, really interesting perspective. And you're right, it is probably controversial, but I agree. There are some issues with safes. David, what's your take on it?
So I'll start with a couple of things. So first of all, we would prefer a priced round. And for folks on the webinar that may not be totally familiar with all these different terms and entities. So what you're doing when you're starting a company is you are selling a portion of your company, and you're in a priced round. Let's just say it's a $4 million pre-money, and you're going to put $1 million on there. So you're going to sell 20% of your company, essentially. That would be a priced round. What Toph is talking about is this vehicle called a SAFE. I forget what the acronym means.
Simple agreement for equity.
There you go. Simple agreement for equity, which is a version, Toph knows a lot more about it, but a version of kind of a convertible note, which allegedly makes it easier and quicker because you're spending less money on attorney's fees, and you have fewer documents at closing. So you want to do that $1 million. But to Toph's point, you'll then do a discounted percentage, a discount to the next round. You'll put a cap on it. So maybe I was talking about a $5 million post money. Maybe you'll put a $3 or $4 million cap on this as a incentive to people to invest. And to his point, we have seen this quite a few times where people will stack safe notes or even convertible notes, which are a little less controversial. And then all of a sudden that all converts in a priced round, and suddenly this founder's gone from owning 70% of the company, and because of all the discounts and all these things, suddenly they own less than 20%, and it's an oh shit moment for them. That, hey, I was building this whole thing and I wasn't really paying attention to it. So we would prefer priced rounds, even at the earliest stages. We're not adverse to doing a convertible note, so we will participate in those. I'm going to be eager to see Toph's white paper on safe notes. I don't have as strong an opinion as he does on those, but yeah, we would prefer price rounds, and would encourage people to do that even from the beginning.
Yep, no, very good. And I'm anxious to see that white paper as well. I think that's a good idea, and it'll be a useful thing. Talk about what other deal terms, what's happening with other deal terms, like things like valuation caps and discounts and liquidation preferences. We touched on that a minute ago, but has the funding climate changed how these are viewed? So do companies need to be more aggressive here in order to attract potential investors? David, why don't you keep going and answer that first?
So one of the things we're seeing is we're seeing terms that had kind of gone out of favor because of competition between funding entities. So things like participating preferred, things which essentially what that means is, let's say we put $1 million in to buy that 20%. If it's participating preferred, you're going to get your $1 million back first. You're going to be at the top of the stack. So if this company sold for $10 million, you're going to get that, plus you're going to get your 20% pro rata. So it becomes more investor friendly and less founder or, employees that have options that are less aware of these things. So you're seeing some of those downside protections come back into term sheets, and it's because it's a riskier environment, and you're seeing some of the returns that private equity, well, less private equity, they kind of bake it in, but venture funds, you're seeing returns suffer a little bit, so they're putting these back in to protect their downside.
Yeah, Toph, anything to add on that?
The one thing I actually would add here is I actually think for the founders that are listening out there, I think this is a great moment. I think that this macroeconomic shift actually relieves pressure from the entrepreneur. And so it enables the founders and the investors to come together in an environment that, back to this, 100% year-over-year growth and false positives on accepting what you think is product market fit, et cetera. I think we can build more quality and successful businesses by returning to kind of more sanity, the way I think about it. And so I don't think that these times are worse really for founders or entrepreneurs. It's painful if they have an outsized valuation, they have to correct it. But folks that are still fairly early in their process, if they have reasonable valuations, and all this stuff, by the way, much of this can be Googled, but at the various rounds, plus or minus 20%, is what you would expect to sell in a given round in those early stages. And if you give yourself the liberty to go narrow and deep, to keep the business simple, to keep that ideal customer profile very specific, your life is going to be less stressful. Not that there's not going to be any stress. Entrepreneurship is definitely stressful, but it's fun. But I think it gives everybody a better chance of success. We still see discounts that are 20%. That hasn't really changed. To David's earlier point, I agree that those valuations that he talked about, we are definitely seeing that shift down to that 4 to 7x range. That's for SaaS, by the way. Interest, on convertible notes has gone from 6 or maybe 7% up to 10% range. SBA loans right now are 11%, I believe, last I looked, in that range. So I would think about all of this as if I was a founder today starting a business, I wouldn't look at this as doomsday. I would look at this as sanity and maybe a more reasonable expectations of myself and that investors have in terms of launching and growing that business, and maybe even a more responsible manner.
Yeah, no, that's a really good perspective.
Yeah. So Tom, one thing I want to add as well. Founders need to do their due diligence on investors and board members as well, and really think about, because sometimes you're so eager to get funded, and you get that first term sheet, or if you're fortunate enough to get multiple term sheets, go out and talk to other founders, CEOs that firm has invested in, maybe even ones that you were turned down by them, to really get a sense, because you're going to be married to these people for, at the low end, 5-6 years, and in lots of cases, 10+ years. And you're going to go through some difficult, dark times, no matter what. And you want to know the kind of people that are sitting around the table with you. And I know this is probably a PG show that you've got, but you kind of want to know assholes rule.
Yeah.
And you don't want to take that term sheet. And I try to encourage people are so dilution sensitive. They're like, oh my, I don't want to give up more than 20% in this round. But you get a term sheet for somebody that maybe is a 25% dilutive event. But they're a great partner at the table. They've been an operator, whatever it is,
Yeah.
or they've got really good contacts to bring in future funding. People need to be more discriminating, and I mean that in a positive sense, around the people that they put around the table with them. That you want people that are going to be really an arm in arm partner.
No, totally agree, David. It's a business marriage at the end of the day, and you got to choose carefully.
Yeah, if I could add on to what David just said, I would also ask investors out there that might be listening, angel investors, early stage investors, just because you write a check for $100,000, don't think that you deserve a board seat. This is how we think at Elevate too, right? Like, just because we invest a certain amount of money at a certain point in time, it doesn't mean that we believe someone at Elevate either should be on the board or has the right to serve on the board to be a board observer. We have a lot of folks that we're building up our operating partner base as we speak. And so looking for real industry experts to place on boards that can be helpful to the CEO at various stages. I think is really important.
Absolutely. I always tell our clients, look for somebody who brings more than just a checkbook, right? I mean, somebody that can really make a difference in other ways. Yeah, no, that's great advice. Let's talk about the core elements of a good fundraising toolkit. So I'm going to kick us off here with one that's kind of near and dear to my heart, and it's financial projections, and talking about how important financial projections are. In my opinion, I've spent probably the better part of my career building financial projections for companies in a fundraising mode, and I will tell you that in my opinion it's the most important tool in your toolkit. And the pitch deck is going to get people's attention, and it's got to be great, but the financial projections will either build or destroy your credibility. So I think a good financial projection model needs to be thorough, right? It has to have enough detail to show that you've done your homework and you've thought of everything and you know what you're doing. It's got to be realistic and attainable, not some crazy hockey stick that you're not going to be able to hit. Got to be well organized, right? You got to be able to show proper unit economics and margins by lines of business. It's got to incorporate the balance sheet, right? You got to be able to show real cash flow. And that's an area actually that I see a lot of companies trip on. They do an income statement only, and you don't really understand cash flow unless you're projecting the balance sheet. Right. And then the other thing I'll say is that it's got to be flexible enough to do sensitivity analysis, right? You got to identify key variables and understand a range of potential outcomes. So, at the end of the day, this is a critical tool. And if you don't have the skills to build one yourself, go find an expert that can help you, because you're going to be judged on the strength of your financial model, in my opinion. So David or Toph, or maybe both of you, give us the investor perspective on this one. Like what you guys are looking for in financial projections.
Yeah, absolutely. So, Tom, I would agree with everything that you just said. And I would say 9 out of 10 founders, entrepreneurs, probably don't have the skill set to build what you're talking about. And even if they do, they probably shouldn't build it themselves, because there's other things they should be doing in terms of trying to build that product or do founder-led sales. Another item I would add to your comments are a financial model and the sensitivity testing you're talking about is not a function that happens at every capital raise. It is a function that you should be looking at every single week. And it's a living, breathing spreadsheet that, I can't stress how important it is to be looking at that thing often and always. Just like I don't think, to me, there's no such thing as a pivot anymore. Like, in essence, you should be pivoting every day, right? Challenging your thoughts every day. So I might add that.
Yeah, no, you know what, Toph, I tell people all the time, it is way more than a one-trick pony. You're not using this just to raise money. This is your decision support tool that you're going to use over and over and over again. Totally agree.
All right, I'm going to pile on. First of all, I feel like this is something that entrepreneurs oftentimes leave to. They're like, I can do that. Just give me my base model. I'll tweak the spreadsheet or the Google Doc or whatever. That sensitivity piece, it is a daily or weekly kind of adventure, because you're looking at gross margins, you're looking at pricing, packaging. Maybe you've had to hire somebody, maybe you've delayed hiring, accelerated hiring. I've never yet seen a model yet from a business being on a board that somebody's hit plan and it's been exactly the same board meeting to board meeting or month to month. So it is always moving, and do it early. go ahead and, put in a plug-in for Milestone. The fractional piece is a great way to get started, get professionals that can do FP&A work, CFO work, controller work, those kinds of things. If you've got the budget and you feel like you need an in-house person, then do that and augment it with folks like a Milestone. But people oftentimes wait too late, and then you've just got a mess that you're trying to clean up, not only from modeling, but also just from accounting as well.
Yeah, so appreciate that. Yeah, so let's talk about the pitch deck and business plan. And Toph, I'll let you maybe talk about this a little bit. I mean, obviously the pitch deck is a core piece of this, but thoughts have changed on this over the years. What do you think makes an effective pitch deck?
So, number one, I would mention that when I started my first tech company in 97-ish, I used this software that we bought at Best Buy to write literally, I'm not kidding you, 100-page business plan that crashed and burned. And I think I literally cried myself to sleep that night when it all disappeared after a year's worth of work, working from 6 o'clock at night to midnight, built this business plan. So those are out the window. No need for that.
Yeah.
So in thinking about a business plan or a pitch deck, I think that being very specific is critical. I think a lot of people want to boil the ocean in a pitch deck. And so being very specific, one thought per page on your typical high level things around, pain and solution and why people are going to buy your widget or product or service, why you're the team that's going to get it done, how big is that market, who is your ideal customer profile, what's your business model, how are you going to make money, if you've raised money to date, how much you've raised, what structure that was in, pre and post money, or if it's debt, et cetera. We'll just lay those kind of high level points out in a very systematic, simple, concise, more words is not better manner. That's step one. I see a lot of entrepreneurs that try to, they think that more is better. And at that stage, I think more is not better. More specificity and less is better.
Yep, totally agree.
Yeah, I'm gonna suggest folks, and we've not been able to invest with these folks, but Emergence Capital is one of the preeminent funds out there. They were first ones into Salesforce and Viva and just a number of Dropbox, a number of places that or companies that you've heard of. They have some great open source tools and templates, and they have the perfect pitch, and it kind of echoes what Toph was just saying in terms of being really concise. It's essentially less than 10 slides, problem, solution, team, go to market, these kinds of things. But they do a really nice job, and this is kind of a time tested for a company that I think has invested over $2 billion and has one of the best success records of a venture firm out there. So I'd encourage people to go check out Emergence Capital. And I think if you just put in Emergence Capital perfect pitch deck, you can find that. But they also have a whole bunch of other open source tools.
Right. No, that's great advice. So I'm going to add another tool to the toolkit that probably a lot of people don't, well, I know most people don't do this well. It's often overlooked, but it's what I call a pro forma cap table. And it's basically a decision support tool for the business owner. Now it's going to add credibility, when you're discussing valuation terms with a potential investor as well, but it's really more a tool for you, the person who's raising the money. And, I will tell you that, it's really essentially a cap table projection model that starts with where you are today. What's my cap table look like today? And then it factors in current and future funding rounds to show, what is the future ownership going to look like? What's the dilution going to look like to the current owners with multiple funding rounds? And it's, the ones that we build typically have exit scenarios too. So you can do a waterfall analysis and you can understand, you can help answer the question, for an individual investor, if I invest X today and they execute on this plan and we do our funding rounds based on the plan, this is what it turns into. That's really important. I see too many investors that start down this path of raising money and they're steering blind. They really don't understand the economics of the dilution and how that's going to play out and what it's ultimately going to translate into. So I think this is a really important tool in the toolkit.
Tom, we just another example here. And this kind of fits into what Toph was saying on convertible notes and so forth that we had recently. A private equity firm came in to buy a controlling interest into an entity, and the entrepreneur and his co-founder did not have a pro forma cap table. So there was going to be $10 million that was going to essentially come into the company at closing. They were thrilled between the two of them and the option pool. They were going to have 8 million of that, and then the investors and the convertible note holders were going to get about 2 million of that 10. When you went and you applied all the discounts and all those stacked convertible notes, it was actually more than the direct opposite. It was like 9.5 million went to all those convertible note holders, and there was about 500,000 that was going to go to the founders, option holders, and they went from this high to really being, upset, mad at kind of everybody in the whole world. But they hadn't. It wasn't the investors were trying to pull anything over on them. They just did not have that best practice of having that pro forma cap table and continue to keep that updated. So we eventually found a path, but it left some people pretty sour out of that. So
absolutely, you got to go in eyes wide open. That's a great real world case study right there.
Yep,
for sure. So let's talk about some of the biggest mistakes you guys have seen companies make. And I know you've seen it all, right? In your careers, you've seen it all, but give us some of the things that people need to avoid. Toph, how about you want to go first on this one?
Yeah, how much do we have, an hour or 2 hours left?
Yeah, we can go to an hour. So let's keep going.
I'm
We'll
just gonna
save
go
a
through
few
my
minutes
own
for
mistake.
questions, but we're good.
I'll just go through the mistakes that I've made in the last time.
Yeah.
But going to market is way too wide. It's not narrow and deep. It's way too wide and shallow. Messy cap tables we've just talked about. Stacking too many convertible notes or stacking safes on top of each other for 2, 3, and 4 years at a time. Burn getting too high, right? Missing your numbers by too much and not controlling your burn, right? As you ratchet up your growth. Too many sales motions. So trying too many things out at one time, right? Trying to sell the product as enterprise or versus product-led growth versus, through channel partners. Those are all very different motions and require different skill sets of people. Hiring your first salesperson when you have false positives of moving from founder-led sales to process-led sales, and you hire that first salesperson, director or VP, and they're going to kind of a coach, player coach, and you hire them from some really big tech company that's been highly successful and is a very sexy name, and they forgot how to make coffee, and they forgot how to, change the pitch or try different, scripts, et cetera. And then it's a year later, and now you've missed your numbers astronomically, and you actually hired 2 or 3 of those people, and you've got to start all over. Those are a few examples.
Yeah, and I'll tack on to a couple of those, but one of the ones I see that Toph was just leaving there is founder-led sales, leaving that way too soon. I mean, the founder needs to stay involved in sales. I don't care if you're coming from a finance background, product, whatever it might be. We see that way too often. People go raise some money and they're like, I don't need to sell anymore. They need to sell forever, candidly, but really be leading that sales piece. Different way of saying what Toph was saying, but I think sometimes people try to be all things to all people. And so it's the everything machine. Suddenly they're like, well, hey, we could, we just sold into this big company. We just sold into General Electric and they want us to do this, and they lack focus. And suddenly they're starting to build product that they don't have the team for, the time for, the money for. We already talked about having a good finance partner from day one. I just see it again and again and again where people don't do that. And then I guess one other one I'll say, having good board management and using your board. Lots of times people view a board meeting as kind of a pain in the ass. I got to build this deck. I got to put all these metrics together. I got to re-educate the board on what we do. I always used it as a is a great self-assessment. And then how do I use the talent of these people to address 2 or 3 strategic topics? Keep your board meeting at like 20 minutes, get all that stuff, expect people to read things beforehand, and use these experts around the table that have different, they're bringing different experience and wisdom to the table to really dive into some real strategic topics and so forth. But I think too often people view it as kind of a pain in the ass that they just have to do on a quarterly basis.
Yeah, that's a really good point, David. And I think you're right. Most people do view it as just this pain in the butt, right? But it's, first of all, I think it's healthy discipline to run, your business with a certain amount of governance and do the board meeting. But you should also include in every meeting, there should be a board member asked, like, what are you asking your board for, right? And make sure you're leveraging them appropriately. So, Toph, I want to leave a few minutes for you to talk about something that I know near and dear to your heart and is pretty exciting. Elevate is launching an exciting new innovation conference in a few months called Rally. And I want you to tell us a little bit about the conference and how business owners looking to raise capital can leverage that event.
Absolutely. Thank you, Tom. So absolutely. So Rally is launching late this August. It's an inaugural year, and the plan is to build the world's largest cross-sector innovation conference. We went out and hired the same event producer as South by Southwest. And so that's what we're thinking about in terms of scale over the next 5 and 10 years. I would like to clarify that we don't think of this as Elevate Ventures event at all. This is Indiana's event. This is our corporate citizens, our economic development commissions, our everybody across the board, startups, scale ups, et cetera, and all in between, university thought leaders, philanthropic thought leaders. All of those people coming together in one place at one time to once and for all prominently put Indiana in its rightful place on the national and global stage. We have, if you think about infrastructure, talent, mission critical industry, technology, lifestyle, cost of living, regulatory environment, these are all components required to be known as a premier innovation ecosystem. We have number 1, top 5, top 10 rankings across the board to punch pound for pound with any state. So Rally this late August this year, August 20th to 31st, rallyinnovation.com. There's going to be up to a $5 million pitch competition in software, hard tech, healthcare, ag and food, and sports tech. There'll also be an entrepreneurship track. We have Magic Johnson coming. We have another global icon we're going to be announcing tomorrow or the next day, Guy Raz, Crystal Washington, Moira Gunn. These are all leaders in their respective industries. And it's going to be amazing. So we're super excited and look forward to seeing everyone there.
Well, we appreciate your leadership on this. This is a big deal, guys. I mean, it really is. And there's a lot of effort going into this. And it's good for the state of Indiana. It's good for business owners. This is just a really exciting event. So appreciate all you're doing to make that come to life here.
Thank you.
So let's switch gears and just use a few minutes here to answer a couple of the questions that came in the registration process. So David, I'll ask the first one to you. So this person was asking, do we have to wait for interest rates to go down before the VC funding path improves? What are your thoughts on that?
No, I don't think we have to wait for that. There's a lot of dry powder out there. There are a lot of firms that have either they're at the front end of their fund or they've got plenty of dry powder. I think what we've talked about through this last 45-ish minutes are some of the fundamentals have changed. So as opposed to just growth at all costs, now there's a much more emphasis and focus on cash flow break even and moving your pathway towards that. So I think it's adjusting the way you go out in the funding environment. And Toph was talking about it earlier, that I think this is a great time to be an entrepreneur. It's a great time to be starting a business. If it's a venture backable business, I think you can get it funded. And it's in a way that is a more manageable way.
No, that's great. It's not all doom and gloom. All right, so Toph, the next question I'm going to pitch to you. So this person is asking, what are the 3 most important performance metrics you look for in an early stage company, given the current market dynamics?
And we'll go with about 5, if I may. So number 1, assuming it's at the very early stage, so the people, right, the founders. And then is there a manageable or a low burn? Is there some growth? It doesn't have to be 100%, but is there 20, 30, 40% growth? Is the structure clean? So clean cap tables that we've talked about today. Are the valuation expectations reasonable? And then do they have the kind of the core components on the team to actually bring this thing to life. So that would be, really the two biggest things we look for would be the ability to build the thing, so technical, and then the ability to sell the thing. Like those are must haves on the team. And if you don't have both of those, at least a plan on how you're going to find the one that's missing. I'd say that's the short list.
And I want to add just to a couple of points that Toph made. One, in terms of that manageable burn, to me, if you're going out to raise money and this goes back to the modeling, come to investors with a plan that shows you, if you raise this money, it's going to give you 18 to 24 months of runway.
Yes.
And the type of growth that might be reasonable for your stage of business. So that's one piece of it. And then also, Toph said reasonable valuation expectations. Different philosophies out there. I'm not a huge fan of people that come and say, hey, I'm raising 5 on 10, and we're closing this in 2 weeks. Go do your pitch, put your data room together, talk to people, and see what you get. Because I immediately begin to kind of shut down when somebody, I just had something the other day and they came and they said, it's $30 million pre. I mean, it's kind of out of our range anyway. That deal's going to get done for somewhere in the low teens. And they're going to do it. But it immediately turns people off if you come in and you're just saying in your deck, hey, and we're raising this much money and here's our valuation. And we need you to turn your term sheet in 2 weeks. It's like, yeah, probably not the optimal way to go about it.
Yeah, for sure. Absolutely. All right. So
I just want to put an asterisk on one thing that David just said. Great point on 18 to 24 months, and really as close as you can get right now in this market conditions, these market conditions at 24 months is really awesome to push towards 24 months of runway.
Yeah, absolutely. All right, another question, guys. This person's asking, it says, it seems that Indiana funds rarely back businesses other than SaaS or biotech healthcare. Are there reasons for that to change? First of all, do you agree with that? And then are there reasons for that to change? What's your perspective?
Is that to me, Tom?
Yeah, go ahead and start us off, Toph.
So great question. I'd say first, all investors aren't created equal, right? So when funds are established, many times that fund has a thesis or a mandate, right, that they pitch to LPs. And that thesis or mandate might be, hey, we're setting up an ag fund. We're setting up a software, a B2B SaaS specific fund. And more specific than that, it's going to be focused on Series A with the ability to carve off 5 or 10% for maybe some seed stage things. So different funds will be established for different reasons. And that kind of exists everywhere. So as I mentioned earlier, 50% of our portfolio does happen to be B2B SaaS, because that's where we had a lot of activity kind of over the last, 20 years. I do think that's going to change. I'm seeing a lot of focus in other sectors like ag and food and sports tech, healthcare, kind of across the board, that are really, really exciting. And so I do want to mention entrepreneurs that understand the fund that you're talking to, because they have mandates or swim lanes that they may have sold to their LPs that they got to stay within. And so just make sure you know that going into it, just to save time on pitching to people who really, it'd be hard for them to invest in the first place.
Well, and I think some of that's going to begin to change in this hybrid and remote world. I mean, B2B SaaS has been where you have companies that have had success in and around the Midwest. And so then those beget other ones, because people grow up and they see that they have talent, they have expertise. So those are folks that go down that path. We don't have as much, for instance, B2C, business to consumer successes in the Midwest. But I think in this remote hybrid world, you're seeing people locate in all different kinds of places. And because we've got talent and other resources here in Indiana, I think you're going to see more and more of those folks relocate here and go from there.
Yeah, very good. All right. So just last question, that's kind of a follow on. So, what do you guys think of the climate? This is a very specific one. This person is asking about seed in the climate for seed and Series A investments in med device companies.
This is a tough one. This is a great question. Whoever asked this, this is a tough one. This may be one of the most difficult verticals to get funding in, right? Because you're reliant on somebody else to even be able to go to market, right? To get your approvals in place, which often take years. We're very skinny here in the state. on available capital. We do invest in these types of companies from time to time. But, you know, $100,000, $250,000, a lot of times doesn't move the needle, right? When they need to be raising, you know, $5 million chunks very early on, as opposed to a business in another sector might only need to raise 500,000 or $1 million, right? So, I would like to see, actually, one of my little fantasies is that we have here in Indiana a dedicated, whether it's medical device or life sciences, but there are much larger funds in other markets that some of our companies have had to move to, because they're required as a matter of that investment. I think it's definitely a place where we can consolidate capital in the future. This is a tough one.
Yeah, for sure. David, anything on that?
I think Toph said it. I mean, obviously we've got this unique area up in Warsaw, Indiana, where you've got all the orthopedic companies, and somehow that by entrepreneurs and success and investment has happened. But yeah, we're thin in the state, and it's talent, and you got to have a really deep checkbook. So you need, you know, $50 million fund like ours we don't have the expertise or a checkbook to go fund those types of companies and have the longevity to partner with them through the years to get FDA approvals.
Yeah.
But
Yep, for sure. We'd all like to see that change, but it's not easy.
yeah, and just a quick note, Tom, as we think about the future, like this is, like, we're number one exporter of life sciences. I think number one exporter of pharmaceuticals. We contribute almost 50% of the $50 billion orthopedic GDP in the United States, right, in Warsaw. These are critical industries in our state. And so us needing to lean in and help those industries more is absolutely critical as we think about the coming years.
Yeah, no, well said. Absolutely. Well, guys, we are out of time. We could go for hours on a few of these topics, but I really appreciate your time. Want to thank everybody for joining us today. This was a great conversation. Appreciate you sharing your expertise. And we're gonna save the webinar, and we're gonna post it on our website if anybody wants to go back and watch it again or share it with others. So thank you guys for joining us. This was great, and we'll talk again soon. Thanks.
Thank you,
Thanks,
Tom.
Tom.
Thank you,
Thanks,
David.
Toph.